And we're live. Hello, everybody, and welcome to another episode of the Bearded Men of Real Estate Show. I'm Ray. This is Dan. Say hi, Dan.
Hi, Dan.
And we are both Bearded Men of Real Estate who have a show called the Bearded Men of Real Estate Show. So I appreciate you joining us. Right as we started, everything was fine. Right as we started, like the internet started going. So hopefully everybody can see us. If you're joining us live, either on YouTube or on Facebook, you can actually comment and we can talk about you or your comment. So I appreciate you. Just like that. Melissa Marr says, the alien is here. So if you don't know what she's talking about, you should Google alien in New Jersey. I would say it's a good year for alien activity. Wouldn't you, Dan?
Well, I mean, if you had, on your Jumanji scorecard, if you had that, then you're right. Aliens in New Jersey, literally flying around.
Yeah.
Just like not even trying to hide themselves anymore. They're like, you know what? It's a crazy year. Let's just show everyone what's up.
Oh, there you go. Ryan Boker says comment. Thank you. Dale Earnhardt. Melissa Marr got
the it's a good year.
A good year
for the aliens to
just watch the video and see if you can tell what it is.
Yeah.
So we got a ton of news. You remember the old NFL when they used to do that? You make the call. I used to love those.
Remember the olden times when people used to make their own decisions based on the newspaper articles they would read?
You can't do that these days.
Nope.
Melissa Marr says just by the Meadowlands during the Giants game. Yep. Speaking of the NFL. You like how I kind of weaved in the NFL? So we have a ton of news to talk about. The biggest thing that we're going to talk about today, and I want your opinion. So if you're watching this and you're a real estate agent, please share it because we need some other real estate agents who could chime in and talk about this pandemic thing. Corelogic released a report that has a lot of people concerned and is saying that there will be a foreclosure crisis coming up. There's also a report that talks about, we almost got into it last week, but we didn't have time. It says forbearance housing market crash bros have a problem. So we have a dissenting opinion. And then we have Gary Keller's opinion on the issue. And we're going to talk about what he says too. So I want opinions, what you guys are seeing around the country, what you think is going to happen. I think we talked to, I can't remember, Dan, if me and you talked about it offline about this foreclosure thing or if we mentioned it last week on the show. So we'll get into some details on that.
We teased it.
Okay. We're going to talk about San Francisco and their exodus and open doors going public. So we have a bunch of stuff. Mortgage demand. Before we get into all this stuff, Dan, would you tell people what Be More is actually all about?
I'd love to. Now, when Ray and I met here on the interwebs about 3 years ago, a little more than 3 years ago now.
Yeah, that's right.
I didn't wear glasses, but Ray did. So,
Dan,
I had actually, my eyes have gotten that much worse in the last 3 years, but I had an idea for a show because I am in fact a bearded man of real estate.
There you go.
And when I met Ray, I noticed something very, very interesting about him.
What was that, Dan?
He can do a spinning backflip.
Kind of.
Front flip.
Yes.
Which is actually true. Usually I make up something about him, but that's actually true. He can do that. It's impressive to see a man of his impressive size do something with so much agility behind it. But anyway, he had a layout for the show, which is the same layout we use today. But also I noticed that he loves to give value up front to his clients. So the show is about being more as an agent, but also being more as a human.
There you go. Speaking of layout, that's a good transition to the flip.
Boom.
Ryan also said, remember when the NFL was about football? Oh, dope. Yeah.
I don't remember when anything was about anything, man.
On the opening day of football, it was really strange for me because there was more attention paid to who knelt and who stood during the national anthem and what people it was so weird. It was weird. Let's just play ball. Can we just play ball and see who the best team is?
I don't know.
It's my opinion.
I wish it was like the old times. And I keep saying the old times, like back in the day when people didn't type on a keyboard that was their, or I don't know.
But they didn't type on a keyboard.
Well, they just, they speak up on a keyboard and we're so empowered on a keyboard, blah, 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 blah.
Keyboard warriors.
Yeah. But Like if back in the day, if I said something to someone and it was offensive, I would get slapped or punched. Now it's just like I can say whatever I want. And we have literally a story about the trolls, about our forbearance crash that's may or may not happen. It's the same thing. It's crazy.
Media trolls nowadays.
Mm.
All right. Well, are you ready to get into the headlines? Because I am.
Yeah, I'm extra feisty today, but yeah, let's do this.
All right.
It's nice.
So last week on the Bearded Men of Real Estate, you may recall an article that we shared about the mortgage demand being up. Do you remember the percentage?
118%.
40%.
40. Oh, I think it was back 3 weeks.
Very close. Yeah. So the mortgage demand was up 40% last week. And we talked about, I just clicked the wrong button. And we talked about the impact on the economy and what that can mean and everything. Well, this week, you might notice the headlines. It says mortgage demand fell last week as interest rates stalled.
And what did we predict on the show about a month ago when all this stuff starts to change and mortgage demand isn't 400%, isn't 200%, isn't 118%? What did we say would happen?
Pretty much exactly what is happening, right? Mike Elizabeth Brodell says, "Yay, feisty Dan." Okay, so let's get into this. Mortgage demand fell last week as interest rates stalled. So the article, in short, summarize the boom is over. That's kind of what it makes you feel like. Mortgage demand to purchase houses dipped this week 1% and were 6% higher than a year ago. Whoa.
Wait.
So, yes, mortgage demand dipped, but it was still 6% higher than it was a year ago. Last year, if there was a mortgage application number and it was like applications are 6% higher than the previous year, we'd be going, whoa, 6% higher.
That's crazy.
Yeah, but now it's only 6% higher. Let's see. So, and I mean, I guess in part that is due to the 40% increase that we had last week. So the overall mortgage demand was driven down 2.5%, due in part to the drop in refinance activity, which is very interest rate sensitive. Right. So here's a quote from Joel Kahn, who is the Mortgage Bankers Association economist. He said purchase activity has outpaced a year ago levels for 17 consecutive weeks, with stronger growth in loans with higher balances, pushing the Mortgage Bankers Association average loan size to a new survey high of $370,200. So the article goes on to discuss, and this is from CNBC, the article goes on to discuss that part of the reason of the increase in that price is the limited inventory. And then, of course, people driving up homes as they're looking and putting in multiple offers and all that such. So yeah, there you go.
Yeah.
And Lissamar says only 6%. Yeah, only 6% higher.
Going limited inventory, which I didn't really believe it was such a thing. You know, I wasn't part of the 2004, 5, and 6 boom. I am a baby boomer. I was born in 1952. So I love those jokes. But anyway, so I kind of didn't believe like inventory was that low and it drove this because it was low. It drove a frenzy, you know, and people just went crazy for it. But I'm seeing it happen and we're still the same. I searched again just here in Rancho Cucamonga, my city. We're at a month's inventory, essentially a little less, a little more. It varies, but it's just crazy. The demand is crazy. And it's that frenzy thing does happen. It's like, oh, there's nothing to see. Let's go see stuff or let's go get pre-approved. And even though it's only a 6% bump rate, that's when you go nationally. I mean, think about those numbers. That's big stuff. But they're like, well, nope, fell. We're all going to crash. We're all going to die. UFOs are coming to the Meadowlands.
Yeah. Brad Daniel said today's special, the burnt men of real estate. Yeah, we're still dialing in the color saturation. We'll get all that figured out. Got thousands of shows ahead of us to figure that out.
We do.
It's going to be, I'm curious to know what the fall is going to bring, especially if there is a foreclosure crisis and there's a whole bunch of properties hitting the market that could increase the number of homes sold, but decrease the average price. And then you'll see articles that say that the price gains have slowed or even stalled, well, you have a bunch of lower end homes finally being bought. And that's where the market is right now in most of the US. So 370 is really, really high for a national average.
Yeah. I mean, that's over 100 grand higher than your average, right?
Yeah. It's right at a little 150,000 more than the average in Little Rock. I wonder if part of that average could be due to the materials cost being so high, Dan.
Well, possible. But did you know that home builder sentiment soars to a record high? But lumber prices raise a red flag. So this one is a little bit lengthy, but I kind of wanted to cover, because we've been talking about on the show for so long, Ray, that we need more new construction. We need more new construction. And finally, they're like, cool, we're doing it. But there's 800 things in their way. They were finally catching up. And then what happened? A pandemic.
Yeah.
So builder confidence, which had gone way down. I mean, I don't think we've ever gotten under 50, but we got down into the 60s. Or did we? I think when the Corona hit, we hit under 50, didn't we?
We got close to it. I think it was like at 52 or something. I think through our entire show, like 50 or 52 is the lowest. It's never gone below 50 while we were. They
consider anything positive in this index, anything above 50 is a positive. So the builder confidence in the market for single family homes in September increased 5 points to 83, which the 78 was already the all-time high. So now that's obviously the new all-time high. But the suburban shifts, this is a quote from the NAHB chief economist, Robert Dietz. He was awesome. By the way, have you guys ever seen Beetlejuice? He's so good in that movie. The suburban shift for home building is keeping builders busy, supported on the demand side by lower interest rates. In another sign of this growing trend, builders in other parts of the country have reported receiving calls from customers in high density markets asking about relocating, which we've kind of talked about, from New York. And there's a story coming up on the show about San Francisco. So while housing demand is incredibly strong, builders continue to be dogged by a lack of skilled labor and finished lots, which we haven't mentioned that part on the show. So now it's just land they're having trouble finding, and finished lots. And now there's a new hurdle: fast rising prices for lumber due to the Rona and the raging fires in the West. So the Rona wasn't bad enough. Now we have crazy fires here in California and Oregon and Seattle. Lumber prices have jumped more than 170% since mid-April, adding more than $16,000 for the price of a typical new single family home. So that lower section, that lower third where we need homes, now they're $16,000 more expensive. So where was I? So lumber producers shut down in March and April as the Rona hit the US, and did not expect to see the quick surge in housing demand that began in late May. So ramping up production while protecting workers with social distancing was not easy, and supply suffered. So to add to that, now the Western fires are affecting Weyerhaeuser, the nation's largest lumber producer. So they manage about 1.6 million acres of forest in Oregon and 1.3 million acres of forest in Washington. And other than California, which two states are on fire?
Yeah, for sure.
So that new construction that we so badly need, finally, builder confidence is crazy. It's at an all-time high, higher in the 35-year history of this index. And they can't get laborers, they can't get land, and they can't get lumber.
I think we were talking about in 2017. I think we were talking about land, labor, and love, materials, just materials in general.
Yeah,
being a short supply, and that affecting home prices, and that was causing what we called then was an affordability crisis. And we've been following that affordability crisis now for years, and it sounds like that's not going to change much. It sounds like the affordability crisis is still going to be there until the lower third of the market can get some inventory somehow. And maybe it's, I haven't thought about this, but maybe it's builders building a whole bunch in the middle of the inventory, which in a sense would stop the increase from other homes that are listed in that same price range.
Yeah.
Because you could also buy new for that same price, right?
Well,
so maybe
not in
that's
California, but yeah,
kind of backfill some of the other inventory, maybe. I don't know where the relief, where's the relief?
I don't see any happening in that lower third. I don't see it happening at all. Finally, they're oh, cool. We'll build homes. We'll build homes. Now it's more expensive for wood. Labor's harder to get. They can't find buildable lots, so they're building everywhere they can here in California. And, but it's not the same though. It's more expensive. Usually there's extra fees that come along with new construction here. So it kind of doesn't necessarily help that lower third or even the middle third.
Right. Melissa Morris says that lot prices right now by her are ridiculous. That's true.
Yeah. I have a friend who does literally, that's what he does for a living is he goes and finds, he doesn't find them, but once they have their lot, he surveys it and he kind of gets it to the ready point. So he takes it from bare land and gets it to the ready point. We should have him on the show so we can have this conversation because it's a little heady. It's a little nerdy, may not be perfect for the show, but it would really, really give you guys some extra knowledge about new construction, especially, here in Southern California, how it works and doesn't work.
I wonder if their cost has also increased just to the development and utilities and all that stuff.
Well, as long as they can get the labor there, he doesn't seem to be having a problem. He's busier than ever.
Interesting.
Yeah. And his predictors are based on other things like bills or laws that are being put into place that seem like a good idea, but they're so under thought. The thought behind them is not enough. So it affects a big chunk of the industry. And it's like, oh man, sorry about that. Yeah. There's a lot of that in California.
Melissa Marr votes yes. All right. So we have one more story before we get into this pandemic news. And if you recall, I would really love for you guys to share the show so we could get more real estate agents on as we talk about the pandemic, because I really want to get your opinion. And those lurkers that we have watching, I appreciate you watching the show, but in just a couple of minutes, that's where I want you to chime in and tell us about the pandemic.
By the way, two things. My father is a lurker. He's never going to comment. I may get Norm able to comment once, but it's not going to happen. Just like I got him to grow a beard once, and it was sweet, but it's never going to happen again. So that may not happen. So so take one lurker off. That's my father.
So hey, Dan's dad.
Yeah, Norm. Everyone say hi to Norm. But the other thing is, this is a thing, and I'm going to take a second to be feisty. Uh-oh, hold on.
Oh,
no, that's that thing.
It's very colorful.
I know, that's that thing.
It's a reset thing. Every now and then, Dan's got to. Yeah, if we could have timed that right, I could have been reading the article.
I know. If I wouldn't have gone off on a rant right now, it would have been perfect. And I was trying to plan it, but I can't help it. Here's the thing I don't understand is ever see a video, and maybe this will be our Be More Chops this week, but you ever see a video that's just stupid as all get out, but it's got 450,000 shares? You ever see that, Ray?
Yeah, I never get that. I don't know.
But here on the show, and I'm kind of being a little bit being serious right now. We try to give this great info every week. And we've been doing this for 115 episodes now, and we average like 8 shares, and we usually get a couple extra shares, but a lot of those are us. I'll be completely transparent. But like, just share the show. We want this info out there. We want more viewers. We want to be able to continue to do this show, and we want to get those stupid videos off of Facebook and push more, educational stuff. And this is good for all of your friends in real estate as well as consumers. They can get to know this stuff for sure. This is all good info for them to know. So just hit that share button. It literally takes a second and a half, and we will love you more than we already do.
Literally. Melissa Mara says, come on, Norm, stop lurking.
Yeah.
Okay, so this next article is about Open Door. We're going to talk about Open Door going public. Dun-dun-dun.
I thought they were.
It's official. So they weren't, but in an announcement Tuesday, the company revealed that it generated $4.7 billion revenue in 2019 while selling more than 18,000 homes. So, okay, hang on. 4.7 billion in revenue.
Whoa. Let's do some math.
18,000 homes.
Hold on. You keep going. I'm going to do some math. How many zeros is billion? 12, right?
God, I don't know. All right, I'll keep going with the article. So I'm just going to read this. This is from the Inman report. Patrick Kearns, I guess. Open Door, the well-funded iBuying startup, is officially set to go public after merging with social capital Hedosophia Holdings Corp. The second. It's a special purpose acquisition company, or SPAC. The transaction gives Open Door an enterprise value of $4.8 billion. So up in the headlines, it says they generated $4.7 billion in revenue Down in the article, it says an enterprise value of 4.8 billion. I don't know. I'm not following that. Usually, if you're generating revenue of 4.7 billion, your valuation is not the same. Here's a quote from Open Door CEO Eric Wu. We founded Open Door to make it simple and instant to buy and sell a home, delight customers, make their lives less stressful, and to build an iconic, once-in-a-generation company. One of many milestones toward the mission. So Social Capital, the second, is SPAC, or Blank Check Company, which is already publicly listed. So basically they're merging with a company that is already publicly traded, which makes them now publicly traded. Does that make sense?
Yeah.
We created the IPO 2.0 platform to identify and partner with iconic technology companies with a proven management system to assist in their transition to be public markets. That's what this SPAC does. So I don't know. It's Open Door's top competitor operates. Hang on. The release also gave some of the first insight into Open Door's operations. In a statement, the company revealed that it sold more than 18,000 homes, generating $4.7 billion in revenue in 2019. For comparison, Zillow's home segment, the area of the business under which Zillow offers, Open Door's top competitor operates, generated $1.3 billion in revenue in 2019.
Okay, so I did the math. 4.7 billion. That's well, 8 zeros. But
yeah.
Okay, divided by 18,000, right?
Yeah.
They made $261,000 per transaction. I don't get it. That doesn't make any sense. Wait, I might be wrong. If that's
Ryan is hitting this right on the dot. Ryan Boker says, "Gotta love tech company math." Melissa Mara says that math doesn't seem right. All right, so I saved the best paragraph for last. I'm going to read you.
260. So average home price is 370,000. They're making $261,000.
Yeah, this is Ryan Booker says the average sale price of $261,011 per house. At what margin?
What if they're leaving something out, like paying their employees and their CEO?
Well, it says top line revenue, right? So that is top line. So that leaves everything out.
So they mean gross.
Yeah, that's what we need. Well, so let's get into that. How much money do you think they made?
Well, if it's
Ryan, if you sold 4.7 billion in real estate, how much money would you make? So the easy way to do this for a real estate agent is to know, well, you know how much you would make off of 4.7 million, right? I mean, we can all do that math pretty easily in our head.
Right.
So then multiply it out for a billion. All right. How much money do you think they made off of 4.7 billion? Well, Ryan says, say they buy a house for 240 and sell it for 260, making 20K. That's only 360 million in revenue. So he predicts that they made 360 million.
But also that's assuming that 20K is all profit. They still have to pay whatever employees they have, you know?
Yeah. So they have to pay people.
I'm going to say they're in the red.
Okay. By how much? If you had to guess, $1 million, 2 million.
Well, if it's Zillow math, then 107 million is a good thing. So I'm gonna go screw it. I'm gonna go big. 27 million.
27 million. Melissa Mara thinks they made 11 million.
I'm saying they're in the red.
Open Door, according to its U.S. Securities and Exchange Commission filing, posted an adjusted net loss of 327 million.
So when I said I think they're in the red and you asked for a number, I knew I was onto something, but I would have never gone to 327 million.
Oh, so now this is up from an adjusted net loss of 192 million in 2018.
So they've lost another 130-ish million.
How come companies that lose money are valued at $4.7 billion?
And how come they're able to say we made 100% or whatever top line, whatever they call it, top line income or whatever, 4.7 billion. How are they allowed to say that? And people go, it's almost like, and I've always felt this way about the tech industry. People just go, dude, that's a hot product. They're going to make a lot of money. And everyone goes, cool. Let's all say they're worth a lot of money. And then people make a lot of money and then they crash and burn like a month later.
Ryan Booker says, bingo, overhead and op costs for 18K transactions, meaning they're upside down 100%. Just keep digging the hole. Haha, yep. Mike Elizabeth Riddell says, there we go. Now we have the right math.
Yeah, that's a pretty good tax write-off. That's what I thought too.
Yeah. All right. All right. So how, it's been a pandemic this year, but maybe because they're going public, they're doing better so far this year. Hint, hint. So in the first quarter of 2020, what do you think it posted as a net gain or loss?
So through April. So before they had a month of the Rona, essentially.
Yeah.
So 3 months of solid production. I'm going to say they're still in the red, and it's 140 million.
That's a little for one quarter.
Yes,
you're close. It was a net loss of 56 million
in a quarter.
Yeah.
I was being crazy. I was just joking.
So if you multiply that out, they're only going to lose about 200 million this year.
But wait, that's still a net loss of 360 million from that. So they're going to be 560 million in the hole.
Someone who is smarter than me about financial markets, and I used to sell businesses, so I know how to look at the white sheets of businesses and see how much they make. And I had a lot of meetings with mom and pop business owners who are losing money every week, and we would discuss, like, how much would you pay to buy a company that loses $11,000 a month? And they're like, oh, we're losing money. Apparently a lot. Apparently 4.7 billion, because you're literally making more. If you bought that mom and pop shop that was losing $11,000 a month, you're making more money for your $4.7 billion investment.
So Ryan has a good prediction.
Ryan says, I say going public, they'll raise $500 million and blow through it in 18 months.
So can I make it in Vegas? So can I make another statement?
Yeah.
If going outside of just what we're talking about as realtors, as real estate agents, for the consumer, do you trust these people to sell or help you buy a home? Please don't.
If they're going to negotiate with my money the way they spend their money as a company, no.
Absolutely not. That's the bigger picture here. We're kind of forgetting about the consumer, and the consumer needs to understand that, dude, 4.7 billion. I'm going to sell my house through them. No, dude, they lost.
They lost so much money. I just don't. Maybe there's like some kind of business valuation or something they're doing that's different, or maybe they're hiding income through expenditures, or
but now they're
weird stuff
traded,
on taxes, but not $350 million. Melissa Mara said, "Well, how long did Purple Bricks last?" Yeah,
less than a year. So now I have a question about. So I was just at Starbucks this morning, and right next to that, there's a Yamaha shop. It's straight up mom and pop shop. They have to close their doors. They merged with another place, but it's 7 miles away, and so it's a bigger dealership. But they sell all the dirt bikes, and they sell some street bikes, and they sell the Razor things. But it's literally their inventory is like 50 motorcycles, etc. That's it. So why do they have to close their doors? But whatever this place is, Open Door can report a $360 million loss and still make it look like a positive.
I'm commenting on the article as you're saying this, that I'm valuing my company about 10 billion because I did not lose 300 million in 2019.
Right. And you can just say numbers.
All right.
Speak it into existence.
Open Doors going public. If you care, there's the finances. I always think it's funny just to kind of review the finances. I didn't mean to spend that much time on it, but that is hysterical to me.
Well, and
I know there's smarter guys that play the markets and they know how these valuations are done. But if you're losing 300 million, how can you be worth 4.7 billion? I don't get
Well,
it.
exactly. And it's possible that they're in it to make money and then move on. Like a lot of these the startups happen. They start it up, they make a thing. Either they're in the money in the game to make a thing that makes a splash real quick and then they get bought, or they're in it to make a to look like an amazing product and get a big valuation and make money, and then they just shutter their doors. So either way, this is sketchy stuff, and you shouldn't sell your house with them
based on their corporate valuation.
Yeah.
All right. So excuse me, got that Rona. So we're going to talk about some forbearance stuff, and I want to kind of do a short breakdown of each one of these articles, right? And then at the end, we could kind of do a longer discussion about all three of these points of view, given the housing market. There's David. Hey, buddy. Ellis Home Inspections. He's checking in. Hey, Patrick, how's it going? He said maybe they're losing money on purpose.
Mm-hmm.
Yeah, that's what I can't figure out. Like, I need to see more info.
And it's also just a world, Ray, that I don't want to be a part of. It's funny to me and we weren't supposed to spend that much time on that one, but
give me 4.7 billion. I'll be a part of that world.
When Ray does this, if you're a listener, I'm literally, face palming myself and I'm home aloneing it. When Ray does that, it takes a lot for Ray to do that. But when
I had to yell.
When you make that happen, we're going to spend a little more time on it. But yeah, so let me just kind of, do you want me to give just kind of
No, you could go ahead and do the whole thing. It'll be better on the chops.
Okay, so forbearance housing market crash bros have a problem. So this is from Housing Wire. And back in April, when the Rona data and unemployment numbers were at their all-time worst, the housing bubble boys, now called the forbearance house market crash bros, had a halfway legitimate 2020 housing market crash thesis, right? They were predicting a 30, 40, even 50% home price crash. Now, if unemployment rates had stayed between 20 and 30%, the economic damage done to homeowners would have been epic. This could have led to a rapid increase in inventory on the market, which would have crashed home prices as demand collapsed. Now, just that sentence right there is super, like, there's a lot behind that. Saying it would have happened is, but they're just making, making a succinct point. So, of course, that didn't happen. Instead, the U.S. housing market has been the best performing economic sector in the world during the Rona. This alone should make you question those ridiculous bubble boy websites, the trolling Facebook friends, Susie Orman, and those YouTube videos of the same ilk. They're all just, oh, cool, it's going to crash. I'm going to get some views. So it's easy to go on Facebook, Twitter, and YouTube and say the current housing market is like 2008 all over again. But if you dig just a little deeper into the numbers, then this thesis quickly falls apart. To be sure, homeowners with mortgages did suffer job losses due to the Rona, but we are still early in the job recovery process. As more and more Americans return to work and companies realize that they can work from home, they are more likely to get off forbearance plans. Though there may be a lag in job gains by a few months. So we've already pulled back since the height. We've already pulled back 10.6 million jobs. So if you want more, go to Housing Wire. It covers specific, income, how it's been affected. If you have a college degree, how you've been affected, what age groups have been affected. It even covers, which one's affected more by job loss and so on. But Ray, if we've recovered 10.6 million jobs and more opening up, how are we going to have this 30, 40, 50% crash that Susie Orman, yes, I'm attacking you, Susie, predicted?
Michael Elizabeth Waddell said, I wonder when Susie was going to be name dropped. Yeah. So, and I think this is what we've been saying for a long, long time. Since May, maybe. I think we've kind of been echoing these sentiments that
it's going to be May.
we said that it was nothing like 2008, 2009, even 2007. That it's a very different economy, that the things that were impacting the credits were not impacting the credits this time around. And so while we see YouTubers and stuff taking advantage of the headlines, which we totally just did if you're catching this on YouTube, so thanks for clicking. Be sure to subscribe, hit that bell, and share. So while people are using that as an excuse to get people to click on their stuff, the reality is that it's not what it was. that yes, we do have a recovery coming, but you saw that chart that I just displayed. It was a V-shaped recovery. It's leveled out a little bit, but it's still going up pretty rapidly. And I think companies are going to be leaner and better and more efficient, so we should have a better GDP in the future too.
Gross domestic product.
Yeah, I don't know. It'll be pretty nice. I wouldn't call it gross.
Hey, and by the way, this is during a pandemic. This is during crazy wildfires. This is during national disasters that are happening all over, or natural disasters that are happening all over the country. And we're still.
Sorry, I interrupt. What did they say? Unemployment was 8.4%, something like that.
Now, yeah. And it again, the article breaks down the different sectors, and some it's in the 20% range, but others it's down to the 4% range.
So if it's 8.4%, that's 2%, 2.5% over. Actually, no, it's 6.4%. So it's 2% over what is considered full employment.
Right.
So anytime you're at 4 to 6.4%, you're in full employment
during a pandemic.
Yeah. So we're only 2% away. Okay. So we've been saying that for a long time, but then Corelogic releases a report last week that may have a very different end. They say that a pandemic may lead to a foreclosure crisis. Now, this is just not a housing crisis, as our thumbnail said, but a crisis specifically tailored to foreclosed properties. All right. So reports of foreclosure crisis have been looming as Corelogic released a report last week that shows a surge in the share of mortgages that are 90 days or more overdue. So that 90-day barometer is I can't remember exactly what they call it. They call it like a severe. I'm looking for the exact name. Hang on. Let me find the exact name. A gauge known as the serious delinquency rate. They've been following that since 2000, or it's been the highest since 2015. And I'm going to give you a quote from a couple of people from Corelogic. His name is Frank Nothaft.
Yeah.
He said, everybody knows Nothaft. He said, if there are new government programs, maybe that alleviates some of the risk, but given what we know today, we could be looking at a serious delinquency rate that is 4 times higher at the end of 2021 as it was before the start of the pandemic. A rate that could result in a foreclosure crisis is what the author adds of the article. This is back to Frank's quote. He said, not only could millions of families potentially lose their home through a short sale or foreclosure, but this also could create downward pressure on home prices and subsequently home equity as distressed sales are pushed back into the for sale market.
Right.
So, and just to discuss kind of how that happens, if there were to be a huge increase in the number of foreclosed properties, I would anticipate it alleviating a lot of the inventory concerns. So we would see the articles that say home price gains stall or home price gains decrease, right? So the rate of increase of home prices will finally start to decrease. It's not that home prices themselves would decrease. He did say downward pressure on home prices. So I think that also has to do with the number and the percentage of homes that would hit the market. But I think this was 2 weeks ago. We talked about a report that, let's see, what was it exactly? Do you remember this, Dan? We were talking about a report in which there were like no foreclosures during the beginning of the year because of the moratorium on foreclosures.
Right.
And now that moratorium was up. And we talked about how the articles and reports would say there was a severe increase in the number of foreclosures and delinquencies. But our question was, would it be equal to or greater than the number of foreclosures last year? Or would it, right, is it going to be excessively over that? And then sure enough, it will be a crisis. We predicted that the sensational headlines and reports would talk about it being a huge deal, that the number of foreclosures for December were triple what they were last December. But if you look at the numbers for the entire year to date, it may not be a big deal.
Right.
Do you remember us talking about that?
I do.
So if you're a real estate agent, this is the kind of stuff I want to know. I want to know what's happening in your market. Do you see any foreclosures that are coming through? Are you still under a moratorium? There are several states now that I was just listening to CNBC before we started the show. Several states have lifted the moratorium. for foreclosures. So we should start seeing more foreclosures finally coming to fruition, which I don't know that that's a bad thing, because they were so low, they weren't even keeping up with the pace that we would consider a normal economy. So get ready to see a lot of foreclosures hitting the market, and get ready for sensational, quote unquote, journalists to use that to get you to click on stuff. But it would take a lot for a foreclosure crisis to happen.
So, yeah, I mean, let's just straight up compare it to, 12, 13 years ago. It's 2020, right?
Yeah.
Okay. There were so many things at play when that happened to cause the financial and housing crisis. So many things at play. But the biggest one was, and I always go back to this one thing, is people could not afford those mortgages. If they had the adjustable rate, or if they were paying interest only, when all those things ballooned, or when all of a sudden those new payments came due, they all of a sudden couldn't afford, like literally, boom, one day, can't afford my house. So I'm going to have to go through foreclosure. So for that to happen again would have to be, I mean, there's nothing in place right now that says, because there's really, we've talked about on the show a little bit, but there's kind of, stated income loans coming back, but then they kind of go away, right?
Mm-hmm.
And it's really only, they're not national lenders doing them. So it couldn't be in this national crisis. So there's really that, but there's also, to me, in my opinion, now no one wants anyone to go into foreclosure. No one wants that. But if it does, in the amount that I believe would happen, which wouldn't be catastrophic, to me, that would just fuel another part of the real estate industry and help those flippers and those investors jump back in bigger amounts. And then that would help, in turn, help other buyers, in other markets, in my opinion. Do you understand what I'm saying, right?
Yeah. And that's what I agree. I don't think it's gonna, it may be.
I think one will fuel the other, and it'll all be positive in the end.
They're calling it a foreclosure crisis, I guess, because maybe it is a crisis if you're being foreclosed on. But if you look at the market as a whole, it's not going to create a housing crisis.
Right. And there's very important distinction. And I'm actually pretty stoked that the article says that. It's just, you need us to break it down. So it says, because people see foreclosure crisis. Oh my God, we're all going to die.
Right. Michael Elizabeth Brodell says banks still want market value for homes. So I just don't think this is going to have a huge downturn in home price. Even if we have more flooding the market, our inventory shortage is bad enough where we'd have to have a ton.
Yeah.
And we would literally need 1.57 million units. That's what we've said so far. We only have 1.5 million units available. Ellis Home Inspection says, so foreclosures are a necessary evil for the market. Dan, great analogy. Yep.
He's saying what I meant to say. So thank you. I appreciate that.
Very concise. Well done.
That's, instead of me being long-winded like I tend to do, I could have just said that.
Maybe you should be on the show, Pat. Well, Savara says a few bank-owned homes that have come on the market throughout the Rona have all gone for way more than asking price, and not to investors for the most part.
There you go.
We are getting people that are buying it and fixing it up for themselves to live in.
Yeah.
Yeah, the owner Ock, Chip and JoJo.
Yeah, and see, for me, what I meant is like when they buy in bulk, when they buy portfolios, but there'd have to be a ton for them to buy, 1,000 homes at a time. So, yeah, and it's going to take a lot. It's just one is going to feed the other, and it's a necessary evil. And
do you think it's going to make the next couple of years harder or easier, just given the foreclosure crisis alone?
Well, it depends on what Gary Keller says.
No, but what do you think? Just given this alone,
just the foreclosure issues?
Yeah. Is it going to make it better or worse for real estate agents? I
think it'll just offset each other. So I don't know if this is a national thing, but for us, when I was first in the business in 2011, 12, we had to have, whenever a market was more than 50% saturated with distressed properties, meaning in foreclosure or short sale or defaulted.
Yep.
Then we had to consider that, but those were discounted. They were discounted. So then then it would affect quote unquote regular or standard sale homes.
Yeah.
I don't see that happening to get to 50% where we have to even consider it. And that's one of the theories, or one of the reasons that you were able to blow Susie Orman's stupid theory out of the water.
Yeah. If you haven't
So
seen that, go check it out.
I think it's going to hit like this V. I think the V is going to dip a little bit. It's going to be tough for some agents, but not all.
Yeah.
And then it'll flatten itself out. Kind of how
it's almost like a reverse V, right? So like
V.
They've kind of been down. I could see a spike in the number of foreclosures as they process all the paperwork and finally get through the moratoriums and foreclose on people that needed to be foreclosed on.
Yes.
Then they are going to hit the people that, man, it sucks. Corona made them not pay their bill, right?
Right.
They're going to hit those folks. They're going to hit landlords that have had tenants not pay their stuff, right?
Right.
So there's going to be a spike in that number. But if I was a bank, I wouldn't want to get through that quickly. I would want to slow play that.
Exactly.
So my own space with inventory. But if everyone does it doesn't matter, right? They're just going to get it off the books. Right. So I think there's going to be a spike, and then it'll kind of come back down to normal levels. That's if it all happens kind of at once. But I think this quote unquote figuring out process is going to take. Yeah. It's going to take months, if not a full year. So I think it would be a slower thing anyway, and then we might even notice it. And the question would be, since it's been so low for so long, will that spike equal out what it is normally or not? Right. Well, so if you average the spike versus the low that we're in now of number of foreclosures, is it going to average to a level line and be like last year, or is it going to be not? Okay. So what about given all of the civil unrest? Gary Keller has an interesting comment that kind of takes into account not only the foreclosure crisis, forbearance, employment, just kind of the market as a whole. So Dan, what is he saying?
So he says, if you don't know who Gary Keller is, he heads Century 21.
No.
Oh, no. Sorry. Gary Keller, 21. Get it? Keller Williams. Okay.
Oh, wait. I do have to say.
Yes.
I clicked on a news story that was like Century 21 is filing for bankruptcy.
Where's that?
It's the clothier. Did you know there was a store called Century 21 that was some kind of like retail store clothier? I didn't know.
They're the providers of those jackets that they used to wear, the gold jackets.
I don't think so. But I was like, whoa, Century 21 filing for bankruptcy. And I was like, oh, it's some kind of clothing store or something. Anyway.
Century 21, the real estate company, should probably look into that. And
no, well, now they got rid of Nick, man. They should have tried to keep Nick Bailey.
Dude.
Keep him. Now Remax got him. All right. Anyway, sorry. All right.
Let's get back to anyway, Gary Keller, he says we're going to have a year or two of tough. Okay. Now that I'm pulling from the article. So if you want, this is on Inman. If you don't pay for Inman, you should. There's lots of awesome things on there. The company's yearly mega camp event, which was being broadcast virtually from Austin, Texas. Keller admitted the current pandemic, economic climate, natural disasters plaguing the country, and civil unrests means this may be the toughest of them all. So
the toughest what of them all?
I think because he's been in this industry for 40 years. So he's seen literally everything. And he's saying this may be the toughest of them all because there is so much attacking what we do as real estate agents. So he says we're going to have a year or two of tough, and then we're going to slowly start to climb out. The pandemic is a very unique situation, and timing on its resolution is uncertain. So this is interesting to me. So this is specifically for the real estate industry. The real estate industry is currently undergoing a K-shaped recovery. I don't know how, I can't even quantify that in my brain. I don't know. I need to go back to Ray. How do I? Is it because of Keller Williams, the K?
They have a K and they think that you have to be at Keller to recover.
Wait, so
how do you chart that?
Well, let's up. Like you go up, now we've got the line for the K, then we come back down, and then we go out, up a little bit and out. But then how do I go backwards?
Backwards and down.
And then back down, and then backwards again.
Oh my God.
And then to draw a K. So I don't understand what that means. I understand W, I understand V, even like a U, slowly down and slowly, but I don't understand what K-shaped means. So get someone on him.
They would have cheered if there were people in the audience. See K-shape.
So they do kind of break it down. So they're doing what?
I'm looking for. Nope, there's no charts. I was looking for a chart. So
yeah, they may be dual. So here we go. Essentially, two distinct groups are having two distinct experiences, which is why the economic uncertainty and high unemployment numbers are yet to be reflected in a housing market that outpaced the year prior in home sales last month. The pandemic has affected different age groups and different earnings. So this kind of goes off the other article and unemployment and all the different age groups. But it affected the different age groups and different earners in varying ways, according to Keller. Those who work in fields make the least and are typically renters face higher unemployment. Unemployment in the leisure and hospitality sector of the economy was at 21.3% unemployment in August, while the financial activity sector was at 4.2%. So well below the full employment rate that Ray mentioned, which is near full employment, according to Keller. So he explains a little more. The reason why the real estate industry has so far not been incredibly affected is because the men and women that make the most of the money are the ones least suffering financially. He goes on, if something doesn't occur to help them or help the men and women who make the least, their lack of employment begins to affect the men and women who make the most.
So that's a trickle up. That's a trickle up economy.
Trickle up. So, but to me, that's a really long-term effect.
Steve has a comment. He said K is for the upper market and down is for the lower market. It's dual. It's a dual thing.
Right. Which
you said that way more succinctly than Mr. Keller.
Yeah. Well, and he's not done. And Melissa also mentioned that as well. So the unemployment rates for individuals between 24 and 35, typically the age of first-time home buyer, was 9.7%. So still not catastrophic. You know what I mean?
Yeah.
And that group accounted for 25% of home buyers in August. So a pretty recent stat.
So this is a reason why we have two articles ahead of this one. And I think Gary, we kind of joke about the K recovery and how in the world would that work. But I think he does kind of summarize both of those articles that we talked about ahead in his view of what's happening in the economy, right?
He covers both.
He covers both. And so that's why as an agent, when you look at the news, you're going to see, hey, the market's recovering and it's great. And hey, the market is tanking and it's terrible. You're going to see both news stories because the duality of the market currently. You have two extremes being impacted extremely different.
When you say the market, we go nationally, but just in my city alone, we have condos at 200,000, 250,000, single families at 350,000. Then we have a $2.5 million listing. So just our market alone is many different
markets within it. Yeah.
Employment markets, right? And who makes that kind of money.
And the reasons for selling those homes are vastly different.
Right.
I mean, he's got good points in there. It's really interesting. You should check out the article on Inman if you have time. But it was, there's people in the comments like tearing him up about the iBuyer stuff and stuff like that. But, I think he's trying to keep his pulse on what's happening. He's always kind of tried to do that. But it's very confusing. I mean, I think in general, it sounds like, well, if that's happening, if it's a K shape, then it also makes sense that it would kind of average out as a line.
So
right, if you have one market doing this and one market doing this, it kind of goes whoop.
Yeah, and I think it's more going to balance each other out. But I do think there's
heartless though, Dan. You can't just say like, oh, all these people foreclosed and stuff. It's not really going to matter that much to the market.
I can say that about the market. I can't say that about the humans behind it. I would never say that about the humans behind it, but I can say that about the market. The market is the market, right?
Yeah. I think he's trying to personify the market a bit. And, he's trying to give, of course, he's trying to give more detail and context to what's going on, but he's also personifying the market a little bit so that.
Well, and I think just like our CEO, good friend of mine for Remax here. I'm with Remax. Just name Adam Contos. I know him well. He's a great guy.
Yeah. He was on our show.
Yeah. I think he's just trying to ease it for his, trying to make his employees, essentially trying to make his people with Keller Williams, trying to make them understand that here's what's going to happen. He's trying to lay it out because right now there's so much uncertainty and you have to respect that a little bit.
Here's his last quote. I don't want our statistical or analytical conversation in any way to demean or dismiss the tragedy that's occurring in real life that we're talking about in clinical terms. So yeah, I think he reiterates kind of what he's done with the K. So interesting way to explain it. I think it's an effective way to explain it to your clients using the K.
Yeah. Because so essentially happening at the same time. That is interesting. So good thing we did that, because now I just learned.
There you go.
So two things happening in the market at the same time.
Speaking of a duality of market, what in the world is up with San Francisco, Dan?
Well, the 2020 San Francisco Exodus is real and historic.
Dun, dun, dun.
A report shows. Dun, dun, dun. So this is from sfgate.com. So I assume that's San Francisco gate.com. And so this is a local article from a local publication, and someone sent it my way about 3 weeks ago. So this is a little bit older, but I've been trying to get someone from, like we had Jay on from, he's from New York City. We wanted that. And it was such a stark difference in his what he's actually seeing and the opinions from outsiders and what they're saying that's going to happen in New York City. So a new report confirms what many have been talking about for weeks. There's an exodus out of San Francisco. And right there, you're like, okay, an exodus, really? And the numbers are staggering. So online real estate company Zillow, we love Zillow, released new statistics shining a stark light on the issue this week. Their quote-unquote 2020 urban suburban market report reveals that inventory has risen a whopping 96%. So that's where it gets real. And even knowing Zillow overestimates and underestimates, zestimates, this is still a pretty gnarly stat, as empty homes in the city flood the market like nowhere else in America. The reason for this change is likely a combination of a few unprecedented factors that have collided this summer, resulting in a historic shift in the city. The astronomical cost of owning a home in the San Francisco city limits, which has been sky high for over a decade now. I like adjusting my glasses. Since the second tech boom, it had to break at some point, and the Rona seems to be the straw that broke the camel's back. Camel gasp. I hate that those camels are being mentioned like that. Like, there's one straw that breaks its back, and we're like, we don't even care about the camel. Jeez. The pandemic soon led to the tech giants like Google, Facebook, and Twitter rethinking what looks like, as many have allowed employees to work remotely for the foreseeable future and maybe forever. This, combined with the fact that most entertainment venues, eateries, and bars in the city have closed, has given many residents, particularly tech employees and transplants, little reason to stay when more spacious, literally greener pastures beckon in relatively less costly regions in California, such as Lake Tahoe or Palm Springs. So if you have that article up, I don't know if you do, you can bring up the graph. But look at that as far as inventory goes, a 96% increase in inventory. Now, they say it is empty homes. That doesn't mean they're empty. That just means people aren't buying in the city anymore. And I think it's, when you have a $2 million home that's 1,200 square feet in the city, you can go buy a 1,200 square foot house for $400,000 outside the city or even farther. By the way, those two cities they mentioned, Palm Springs, I mean, that's 8 hours away, and Lake Tahoe is, I don't even know, 6 hours away. When you can move that far away and still work and still be effective in the tech industry, what's keeping you in San Francisco? And I think that right there is the big difference between San Francisco and New York City.
Yeah. And there are some other reports, like some follow-up reports after this came out. The same Twitter user looked at the normalized data for inventory over time and figured out that they did have less inventory leading up to this moment.
Yeah.
So they're like, well, so it's kind of normal. But no, it shows an extreme shift. If you say they had less inventory, then that shift to even 90%, I mean, that's a huge shift compared to the desire of people wanting to live there. So it still shows people turning their backs on big cities.
Yeah, but hey, the positive is it's a buyer's market right now in San Francisco.
Maybe.
Yeah,
for sure.
Go offer $200,000 less than something's listed for.
We need to get Debbie back on the show. She hadn't been here in a while. Isn't she in that area or no?
I don't think she's in. I wanted in San Francisco, like the city.
I get you.
Not just because I reached out to a lot that work. Now we can have someone on like Paige. She's getting the benefit of these people. She's like, dude, it's crazy. Everywhere she works is getting 20 offers. She has to compete. They have to go way above asking, and we can't have her on. But I think that's you can see that from an outsider's perspective. That's an easy point of view to see with looking at any numbers. But I want to hear like the real, like, hey, it says you have 90% more inventory right now. Is that true? Yes or no?
Melissa Mara said San Fran in particular, with all the big companies operating there, they're all working from home now. What did everyone expect? There's no longer a mad dash to get in the city to be close to work.
Right.
Yeah. Interesting. Well, that's it for today's show. Pretty quick. That was pretty quick. Yeah, an hour long. Good job. Well, if any of you have any questions, feel free to reach out to us. You can reach out to us on our Facebook page. It's the Bearded Men of Real Estate, or our YouTube page. You can comment. Be sure to like, subscribe, watch the other videos that we're going to put around the screen about this time if you're watching it. But Dan, where else could everybody find you?
Not on Facebook.
Where else then? Did you delete it?
I didn't delete it, but I don't go there. I don't have the time for it anymore. So, but D Ledrick Rocks, you can go. I have a YouTube channel that I'm currently building out.
Nice.
And then I also have a second channel. It's called Daily Dose of Dan, Daily with Dan.
Love that show.
That I'll just put up dumb things every day. And then Instagram, D Ledrick Rocks, DLUDWIGROCKS.
Instagram, the Facebook.
And also, if you guys haven't watched it, you need to watch The Social Dilemma.
Hey, look, Greg Taylor's on. What's up, Greg? He said, looking great, guys. You too, buddy.
I'm a little burnt, but I appreciate the...
We do need to adjust your saturation.
We're still dialing it in. I got so many settings on this camera that I don't understand. But
you guys can find me at Ray Zorback. I am on the Facebook, but I probably won't accept your friend request. It's RAYZORBACK. And don't be offended. It's just because I don't know who anyone is anymore. But RAYZORBACK. Follow me there on Instagrams and also the YouTubes. And hopefully we will see you guys next week. Oh, and look for the chops, the Be More chops that are coming out. We're going to take little segments of these and share them to make them a little bit easier for you guys to share around the interwebs.
And we're working on the overall production behind these too. We have a little intro now that has our own little sound that starts the show, and it's kind of cool. So we're working on all that stuff. But
Greg agrees with your Social Dilemma. He said, great plug. Watch it.
You absolutely have to watch it. It's not
as everyone on the show has the little F by their name because they've all commented from Facebook. Here we are, dogging Facebook. Y'all should probably check out YouTube. The YouTube channel would be great to check out. So bye, everybody.
Bye. I love you. What knocked me out? Something. What knocked me out? I love you. Bye.